Welcome to another edition of Death, Taxes, Money in the Law, presented by Axiom Founders Family Office. I'm Thomas J. Markey, CPA and a newly minted certified exit planning advisor. I'm also joined with my business partner, Armando Roman. What we're looking at here on the screen is a recent checklist that we send out to all of our clients before we meet with them before the end of the year. Armando, I thought I'd bring this up and I thought we'd maybe try to convey the importance of why is it important to meet with your advisors, whether it be tax or your financial advisor before the end of the year.
Good. Yeah, and this being the end of September, this is a perfect time to go through this checklist.
Right. Yeah, and that's part of our job because Armando, a former CPA, me still a current CPA. We both worked at tax firms. Unfortunately, they're more reactive. They're not proactive. So when we started our firm, we said we want to be proactive. So we kind of want to know what's going on in our clients' lives. So let's kind of touch base on some of these questions here, Armando, and give your insight into that.
Yep, certainly, certainly. So
Well,
really just going from upper left hand to right there, that asset and debt category that we're looking at, what it makes me think about is read about, taxes in the first line, taxes in the second line, and RMDs in the third line. That is really all about taxes. And yeah, like you mentioned, Tom, I had a tax practice years ago. I sold it almost 20 years ago now and was a licensed CPA over 30 years. And taxes are a key component of of a drain on the income, and they can be a drain on what goes to the heirs and beneficiaries. So being mindful of taxes always, always, always in what you're doing and what we're doing for a client is very, very important. And so the category about, investment losses, yeah, that's pretty straightforward. If there are unrealized losses in stock holdings that you have in your portfolio, and it's not an IRA or 401k type of account, then it makes sense to consider, do we go ahead and sell that, take that loss, and maybe offset that loss with other gains in the portfolio? It's pretty simple and straightforward. We do that, of course, as you know, Tom, all the time. It's just part of how we do things here. And it's a little thing, but we found many, many times that by being aware of those unrealized losses, and unrealized losses, what that means is if you look at your holding of a specific stock or a mutual fund or something, that holding, you're negative, you're below what you actually paid for. So you have a loss in that account. And that loss doesn't really matter for tax purposes until you sell it. So we'll sell that to trigger that loss. So for tax purposes, now you have a loss that you're going to use in this current tax year. And we can use that loss to offset gains from other stocks, other holdings that were sold that triggered some kind of a gain, a long-term capital gain. And you can offset one against the other. And net tax wise, you're in a much better position when we line those two up and make them happen in the same calendar year, the same tax year.
yeah, so an example of that is we are proactive with our money managers and our clients. So based on our clients' income situation for the current year, what should their tax budget be? And then we can kind of go to the money managers and convey that information. Hey, we're thinking there's a $50,000 tax budget. There's a $75,000 tax budget. There's 10,000. So back to our model's point, then what they'll do is manage those investments accordingly. And sometimes it's a great opportunity to kind of de-risk the portfolio or get it back into a balance as to what the clients are trying to accomplish. So you're kind of killing two birds with one stone.
Right. And it
RMDs
really
are
is
motto. Oh, sorry about that.
it's
RMDs
just
up
a
here, we see
team.
this letters all the time. We're very familiar with it. Our clients sometimes aren't. Ultimately, who's responsible for these is the client, and sometimes they think because it's a tax thing that their CPA is going to notify them of it. Well, no, that's not always the case. But we try to manage these too. Back to we know these are coming down the road. So when our clients are 65, 67, 68, and we know R&Ds are going to be at 73 now for most folks, is there some way we can maybe manage those investments that are in those qualified accounts to where maybe the RMDs aren't so large when they kick in.
Right, exactly. And RMD is just an acronym, required minimum distribution. That matters when you're in your 70s and you have to take the money out. IRS gives you a tax break to put money in, and IRS requires you begin to pull money out at a certain age. And as you said, Tom, it's about age 72, age 73. So understanding that that's coming and that every dollar you pull out of those accounts will be taxed, just like you got a W-2 paycheck from an employer. Every dollar coming out, it will be taxed. And there are some exceptions to that when you are charitably minded, but that's probably for another conversation.
Right. You touched on the capital losses, carry forwards. We've got some, again, we touched on, we always kind of want to know where our clients are as far as their income for that year, because that helps us make decisions as far as should they commit contributing to the traditional retirement plans, which is the IRA, the 401ks, 403bs, or should they shift some of that money over to the 401k Roth, 403b Roth, or an IRA Roth?
Right, exactly. The
And this kind
different
of ties into this up
goals have
here. Are you
different.
on the
Yeah,
threshold of a tax bracket? So that's back to I made a post today, social media post that hey, some of these tax brackets, like the 22%, 24% tax bracket, there's almost a $200,000 spread between those two brackets for a married filing jointly. So is there tax planning that you can do to kind of take advantage of that big, huge spread in that tax bracket without shoving you into the next highest tax bracket?
right. And that gets to the timing of income as well, which I think is on one of these items here that, what do you expect for income this year? What do you expect for next year? And some people know because that's how their income is very steady Eddie. They know what it's going to be. But many people don't. Will you get that bonus? Will you get that big contract award? Or is it going to be taxable this year or next? So that just gets back to that you have to actively manage the taxes by understanding the income, the profit in the business, and understand the whole picture to really make it all make the most sense and get the most benefit from it.
Right, and here's some more letters. We saw RMD letters before. Here's IRMAA. So back to Uncle Sam. Holy cow, he gets you there, here, he gets you there. So this has to deal with Medicare. That a lot of times what they're looking at is your two previous years of income, and then those Medicare charges are based on that. So we try to manage that accordingly. So back to if we are going to do Roth conversions right before their Medicare is kicking in, we want to be cognizant of that. Sometimes Roth conversion is still worth doing it, even though it bumps your IRMA in. But back to we want to be proactive and communicate that to our clients so they're not surprised when they get these IRMA charges showing up on their statements. Armando, you love this one. Are you charitably inclined? Of course, our clients, part of our client profile is we want them to be charitably inclined, and fortunately, most of them are, and they love to get back to the community. Maybe touch on some of the different things that you can do if you're charitably inclined.
Yeah, so there are some really nice, very interesting things that people can do that they're often just not aware of. And often it's interesting. People will have, say, a holding of Apple stock that they had forever. They bought it when it was very low, and now it's worth a lot of money. And if they sell any of that holding, then it's going to trigger a big capital gain for them. And so that's not, nobody wants to choose to pay more taxes typically. But what you can do when you have that kind of a holding in your portfolio where you have a lot of gain attached to it, you can give that stock directly or part of that stock directly to charity and let them get the full amounts. If you give away, say, $100,000 worth of stock to a charity, they get the full $100,000 and they don't pay tax on it. It's just revenue income for them to use for the charitable purposes that they're there for. Whereas if you sold that stock, then you'd have to pay 25 to 30% capital gains taxes on it. And if that happens, then you're left with, say, 65 or maybe $70,000 or so, and you give them $70,000 out of the 100. Well, better for them and better for you if you just give them directly that stock as a charitable gift and let them get the full $100,000. It's a simple little thing that can be extremely impactful in the right situation. And that's just one little strategy that we've used many, many times before. There are many others out there as well. So people who are charitably inclined, a lot of ways that we can help you get there, but we have to understand the whole picture, what you're trying to get to, and then we can figure out what the best way is for you.
Yeah, and I think what you're kind of talking about is a donor advised fund. That's one of the tools that we love to use. But unfortunately, like we said before, the CPAs they're always reactive. They're not out there promoting donor advised funds or these tax saving strategies. And as Armando mentioned, you might be able to help your local charity out without changing your lifestyle at all. If you got this highly appreciated stock, as they mentioned. The tax code very friendly towards business owners. That's primarily our client base, so we always want to make sure that we're looking at any tax planning opportunities. Anything you want to touch on there as far as business owners and tax planning before the end of the year?
Well, yeah, the business owner always has a lot more on his or her plate than the person who does not own a business. And because of that, we want to see them well before year end, so that if there are things that can be done to help them from a tax perspective, then we can do that with them. And I know I've said a lot about tax in this conversation, but there are often two sides to that. Yeah, there's the tax savings, but you're also getting something in exchange. So with charity, you're having that charitable impact you want. That's the other half of that coin. With putting money into an IRA or a 401k or a cash balance plan, yes, there's a big tax savings, and the money you put in, it's adding to your retirement portfolio, so that when you do retire, there's more money in that pot to draw from. So they're always, it's kind of like a bit of a teeter-totter. Whenever we're doing something, there's a one thing that is the tax component often, and then there's the other goal we're trying to get to as well. More money in there for retirement, bigger impact for charity, more money for the kids, more money for the grandkids, help the grandkids get through college education, help pay down debt on the house, whatever it is. But there's always some other side of that coin that's part of the goal, the overall goal that family has as well.
Right. And then that's a key word you just said there, the goal. So we will talk with our clients. What are their goals for their personal lives? What are their goals for their business this year? So if they're looking to purchase assets for the business or they want to buy some properties, et cetera, some investment properties, we see this section up here where it talks about accelerating or deferring costs and expenses. So if our business owners are having an incredible year, they're banging it out of the park, well, then are there some expenses that or a cost segregation or one-time deductions that we need to take advantage of this year? But if they're having a bad year and they're because a lot of these business owners, there are huge fluctuations in income sometimes from year to year, then do we need to defer some of the expenses or maybe postpone buying those assets? Um, Cash
Right.
flow issues, Armano HSAs, health savings accounts. I heard you mention earlier today, we had a little conversation. You talked about, holy cow, this is an unused tool. Not huge numbers here that we see right here, but man, if you
Right.
do this over 10, 20
Right.
years, 25 years, and then you set that money aside into investments that get some compounding interest, we're talking about two, three, $400,000 that you could have for healthcare expenses in retirement.
Right, right. And that's all at in clips at maybe 4,000 a year, maybe 5, 8,000 a year. But over time, it really can add up to be something significant.
It's also the only one that I know that's a triple tax savings. So you can put money in, you don't pay any taxes on that, and you can pull money out. You don't pay taxes on that as long as it's towards medical expenses. And then all the growth in there is tax free.
Yeah.
Retirement plans, Armando, that's a big subject that you're an expert in that. We meet with our business owners, individuals that are working for corporations, et cetera. What kind of retirement plans do they have available, and then what should they be doing as far as taking advantage of them?
Right. There are lots of ways to get to that in that return plan space. The one thing that I'd say that people often don't they just don't know is that when they have their own business, there are additional plans available that can be extremely, extremely impactful, just incredibly impactful. But then also people will often retire and then go on a board of director, become a board director for a corporation, and they get paid for that board director service. what is really important about that is that income is what's called self-employed income. And because of that, they can put significant amounts away into their own brand new uh, qualified plan, which is also called a their own retirement plan. So they might get a couple $100,000 as a board director from that company after they've retired. They don't really want to pay the taxes on that income. They don't necessarily always need that income for the living expenses, but what they're able to do is create their own retirement plan solely to receive that income. And the tax savings, the addition to the portfolio, it's just amazing the impact that you can have by implementing those types of retirement plans when it makes the most sense for that family.
Right. And how many CPAs are out there promoting these?
Well, and I think what happens, to be fair to the tax CPAs, they've got a lot to get done in a short time, and all of them are overworked. They're short staffed. So in fairness to them, they're pretty darn busy. They're getting things done by the due date, and they're getting things cranked out like they need to. And with more time with that particular client, then they would have time to explore things. We make sure that we explore those things, and we're very intentional about that. And then we will bring those opportunities and potential strategies to their tax CPA, to the client's tax CPA, to have that conversation with him or her to make sure that that will or will not work in that situation. So those are the set of eyeballs, Tom, that you and I, of course, provide for that client and for that family, taking it to the tax CPA, take it to the tax attorney or whoever needs to be part of that conversation as well.
Right. A lot of our clients, again, charitably inclined, whether it be the grandparents or the client themselves, they want to help children, grandchildren with college funding. We've done this in our house, in our Axiom Founders Family Office, where if the grandparents want to help the children around, let's set up some 529 plans and they can gift to the grandchildren and they can bunch those up for some significant tax savings, right, Armando?
Exactly. Right. Right. They can bunch up 5 years worth of 529 contributions and just write one big fat check to that newborn infant. And when the grandparents are able to do that, just think about it. If $100,000 goes in today for a baby who's 1 day old, as an example,
Right.
that kid's not going to go to college for another 18 years. Over 18 years, how much will that $100,000 grow? Well, it'll be substantial. And if they end up going to a top university out there that is super expensive, you know what? When they've got that kind of money on day one when they're first born, probably not going to be an issue to pay for it.
Right. Yeah, that's huge. We got some insurance planning issues, estate planning issues, other issues. Anything you want to touch on here, Amano?
Um, there's a new tax law, of course, this year, so that I've kind of beat the tax horse dead here, but taxes, of course. But estate planning, I want to touch on that just for a second because even when estate planning documents have been done correctly and appropriately at that time in someone's life, well, whenever those documents were done today, now your situation might be a little bit different. The financial picture might be different. The marital status might be different. So there are many things that change as we go through our lives. And the point about that is the estate documents, they need to adapt along with your family and your life. So it's very important to not forget about those estate planning documents and to revisit them. And even if you just did them in the last 5 years, maybe just go back and take a quick look and say, and just see who is the trustee, who is going to be the one to pull the plug on me if I can't talk and I'm in a coma in the hospital, who has the authority over my bank accounts, who can sell my house, because all those things are changeable. And the person who was picked to be that responsible person, say 10 years ago, you might want to pick somebody else today because their situation has changed.
All right. So we got a question here. You ready for a question?
Yep.
So one of the people here, they're asking, they have I guess it's a thrift savings plan. They're calling it a TSP. And they want to know if they still have to do an RMD.
Yeah, a thrift savings plan, for those who don't know, those apply to government workers. and military personnel as well. So they get what's called a thrift savings plan. To you and I, who are not military people, we would call it basically a 401k. Because for all intents and purposes, it's the same thing. And yes, it has those same rules that a 401k and an IRA have, meaning when you hit a certain age, you must take required minimum distributions. And that's just how it works. So the whole retirement plan space, the rules that apply, the ERISA rules, the ERISA is an acronym, but that's what governs all of the retirement plans, all of them, including the TSP, the Thrift Savings Plan.
One more question um, we had here. So I'm doing gifting. Am I supposed to report that to my tax preparer?
Well, actually, yes. There are annual amounts you can give away as a gift, and there's no tax for you, no tax for the person who received the gift. But it is important to report because there's what's called a lifetime exemption amount, and that lifetime exemption is for two different things. One is for estate taxes, and one is for gifting. And actually, it's really one bucket with two different ways that you can use it. One is for gifting, and one is for when you die, and it goes to your beneficiaries as an inheritance. But it's one bucket, only one bucket. That's the lifetime exemption amount. So to make sure that during your lifetime you don't exceed that lifetime threshold, it's important to keep track of that year to year to year. And what some people will do is they'll give gifts every year up to that maximum, which they can do because the annual gifts up to that annual maximum, that is separate from that lifetime exemption. So, wait, is that right? Yeah, I think that's right. But
Yeah.
each year you can give annual amounts away, and the annual amount changes a little bit from time to time. But it's very common for, say, wealthy grandparents who have plenty of income, plenty of assets. It's very common for them to gift to their own adult children and to their grandchildren every year because they can. And from a tax perspective, that's what should be happening from a tax perspective.
All right, awesome. So that's it for today for another episode of Death, Taxes, Money in the Law, where we talk about retirement planning, investments, tax planning, estate planning, and charitable giving. So thank you again for joining us for another episode.
Yep. Thank you, Tom.